Okay, so we should be live right now. Welcome to this live stream if you're watching this live, and welcome to this video if you're watching this after the live stream. Anyway, today we're going to be doing some accounts questions, and yeah, that's what's going to happen right now. So hopefully you guys can hear me audibly, and yeah. Anyway, let's begin. So, depreciation, past paper questions. A topic that I really find hard, I guess, I think, according to me, maybe. You guys have your own opinions, but that's just me, you know. So anyway, today we're gonna do like a different type of live stream. So it's a double live stream, you know, that what's gonna happen is that I get a question and we're gonna research on that question. Like, you know, if seen the other live streams, that's what's gonna happen. So similar, but this one maybe we might even like actually see proper notes on that or something like that. So let's begin. I think they are both the mix of multiple choice and the other ones. Now you can find the questions down in the description. It is from igcsseaccounts.com. So a huge thanks to that website before we start. So all the questions are from them. So simply all these questions were like from IGCSE, but then they simply combined everything into one document for the purpose of revision, and that's actually really smart. So you know we can focus on one topic at a time, and you know not wasting any time finding a sort of topic. Anyway, this is a live, so you know it's going to be quite long. Try to do some questions with me if you're watching this live, even if you're not actually. Try to figure it out as I'm going to also do that. Anyway, so basically the purpose of this is that you understanding some of the depreciation questions by the end of this live stream. So technically, I'll try to do as much as the questions revision and everything. You know, starting with the basics. Okay, so we start with question number one. Peter bought a non-current asset for 5,000 and he depreciated that at 10% per annum. So per annum means per year. So on a straight line basis. So first of all, the first thing we're going to be doing is researching on what is the straight line method of depreciation. Okay, because it's asked a lot, and if you've noticed that, that's one of the very big sort of questions. So I'm just going to write this IGCSE PDF so we can have a look at that, and then we can go through that. Okay. Uh, Now this was the question. Sorry, we ended up back to the question. Methods of depreciation. Someone has posted that as a revision note, so we're gonna have a look at that in just a minute. Just as it loads up, so you can see it's a multiple choice right here, and it says what was the profit or loss on the disposal. So disposal simply means when you sell it, what happens after that. Okay. So here we have. I hope you guys can see. Hopefully you guys can see. Can you guys see? I'm really hoping you guys can see. Let me just quickly zoom into this. I'll have to keep on like sort of doing this. It's gonna be a bit annoying, but you know it's fine. Okay, so now hopefully you can see it quite better. I'm gonna get the pen tool out so I can also like sort of explain. First of all, it says depreciation may be defined as a permanent and continuing diminution in the quality or the value of an asset. Now, we're just going to straight go to the question. So first of all, this one is talking about, uh, uh, sorry, I think you guys can't see right now, but basically, let me show you the topic, the question. Simply, if I bring it right there, it says that it has been depreciated per annum on the straight line basis. Okay, so when it says the straight line basis, we have something to do. So right here we can see this is the reducing balance, this is the straight line balance. So we are focusing on the straight line balance. So a straight line balance is simply a fixed or equal amount to be charged as depreciation every year during the lifetime of the asset. The amount of the depreciation remains equal. So that's the main thing right here, equal from year to year, and the expected lifetime of the asset is calculated and the cost of the asset is spread over lifetime. Okay, so depreciation per annum. So let's do this question now. Let's put it back there. Okay, so let's just erase this and start. Okay, so first of all, it's 10% per annum. Okay, and at the end of 2 years, he sold it. Okay, Now, I don't have my calculator on my laptop, so I'll have to also sort of include that, but I'll have to also add that in OBS because that's my streaming software. So I'm gonna just quickly open calculator and add that up right here. So I'm gonna add the calculator into this. Okay, so hopefully now you guys can see a calculator on your screen. Okay, and here's where I'm going to be doing like some of the basic functions of this sort of thing. So I'll minimize the sort of calculator because it's quite needed. Okay, so let's put it just aside right there. Okay, and let's begin. So the first thing it says is that 10% of annum. So I'm going to do 10. Okay, divide by 100, so that's 10 over 100. That meaning 10%. I'm going to multiply that to the actual sort of 5,000, which was the actual cost. So that's going to give me for 1 year. Okay, that's 500. So that means that I am minusing 500 per year. Okay, if you guys got that, 500 per year is getting minus because we've got to know that, you know, um, straight line method basically is 500 every year. Okay, so we've calculated that, and once when you've calculated that, meaning it says every year 500, so in this case for the end of 2 years that's going to be what, 1000, right? 1000, and that means from 5000 we're going to have to 1000. Okay, so that means that right now it would have been valued at 4000, but we sold it for 4100. What does that mean? We got $100 of profit. Okay, right now it should be actually 4000, but we got 4100. So the answer is $100 profit. Okay, so that's how you do the straight line methods. The answer is D. The next one says software bought a machine for $10,000 and depreciated at the rate of 30% per annum on the reducing balance. Okay, so this time it is reducing balance. So let's see now how we can do the reducing balance. Now I'm just gonna quickly remove this right here, remove the calculator for now. We'll come into the calculator later. Okay, so we'll come into the calculator, but you know, we'll have a look at it later. 1 second, let me just add it and just keep it aside of the screen. Okay, let's move on. So now hopefully can you guys see this? Okay, so just scoot it up right here. So now we're having a look at the reducing balance. Okay, so we looked at the straight line method, we got that, and we got that answer correct. Okay, now we're having a look at the reducing balance or the diminishing balance method. And this basically means that the value of the asset goes on diminishing year after year. The amount of the depreciation charged every year also goes on declining. So the depreciation charged every year goes declining. You know, in the other one it was fixed, but in this one every year a fixed percentage of the net book value of the asset is reduced. For example, 20% depreciation is charged. If the asset has a value of 10%, the first year will be 20% of 10,000, 4,000, and then 6,000. So I'm going to teach you how to calculate for this type of case. Okay, so here we have the question. Okay, and it says that 10,000. Okay, sorry for the terrible handwriting there. It says 10,000 is when you bought it. Okay, and it's saying what is the net book value at in year of two, the second year. What is the net book value of it on the second year? Okay, so the first thing I'll do is to find the 30% of the 10,000. Sorry, so I'm gonna take my calculator out right here. Sorry, yeah, I'm gonna take the calculator out right here, and let's do it. Okay, so with this now I have to first of all do 30%, so that's going to be 30 divided by 100, and I'm going to be multiplying that with, which is 30% there, and I'm going to be multiplying that with 10,000. So 10,000 what's equal, so it's 3,000. So on the first year I am removing 3,000. Okay, on the second year I have to do 30% of 7,000. Okay, 30% of 7,000, because now I have to minus it. Okay, so I'm gonna do 30 divided by 100. Now it seems like I'm taking a lot of time in just 2 more questions, But again, because this is going to be much easier after you do it much quicker. So 7,000 equals, so 2,100. So this is going to be 2,100. So this is 5,100. Is that right? So this is minus to 10,000. So if I do take out my calculator and do 10,000 minus 5,100, I should get 4,900. So the answer of my net book value will be 4,900. The answer here was the profit of $100. Okay, there you go. We finished also the reducing the emission balance. Sorry. So we got that also correct, and hopefully you are also understanding that. So let's just put that back aside and rearrange my screen. Okay, so let's begin now. And now let's have a look at why is depreciation provided. So let's have a look at each of them. Why is depreciation provided? Number one, to estimate the cost. Okay, to estimate the cost of the business of the wear and tear. I don't know. Let's see. We're gonna come into this to set aside funds for future. I think this one is for sure wrong. C, to show market values in the statement of financial position. Wrong. I have doubt. To spread the cost of an asset over its useful life. So this one seems to be correct. So the answer is D, to spread the cost of an asset over its useful life. Okay, and we can also search it on Google, and let's see what Google tries to give us. So I'm going to see what Google says. So let's just put it back up there. Okay, so let's see what Google says. So this one is, why is depreciation provided? Why is depreciation provided? So you can see depreciation needs to be provided because an asset is bound to undergo wear and tear over a period of time. So you can see that here it's to estimate the cost of a business of the wear and tear. But here why it's wrong is because it's not mentioning the asset. Okay, so here the keyword right here is the asset. Okay, it's correct, but it's the asset. Okay, so I hope you're understanding that if the asset was there, then this would be correct, but this one is saying the estimated cost of the business. Depreciation is not for the business, but it's for the non-current asset. It's for the asset, okay, not the business. So that's where you would have got wrong if you did the follow. Okay, we move on to number four. And number four is now a proper question that we're going to be doing. Okay, and again, we're going to be doing some research and figuring out a way on how to solve such a type of paper or sort of question in this case. So on the 1st January, always take like your pencil and highlight the key amounts, okay, and what they want. So the first one says on 1st of January 2014, Alex had a motor vehicle, okay, with an original cost of $17,000. So that's the net book value. 17,000 was the brand new price, okay, on which the depreciation of 6,800 had been provided, okay, meaning that it's done. So 6,800 has been done, it's provided. It then says on the 1st of April 2014, he bought a new vehicle, and this one cost 24,000. Let me put it back up. So yeah, so this time it cost $24,000, and he sold the old one and received a check for 9,400. So probably we'll be making a disposal account. Yes, we're making a disposal account. And because I know that because he sold, whenever he sold one, he gets money, and this would be then to the disposal account. So he sold the old one, which is this one. Okay, he sold the one costing $17,000, and he got a new one, $24,000. Alex provides depreciation on the motor vehicles at a rate of 40% on the reducing balance basis, and he allows a full year's depreciation on the year of purchase and none in the year of disposal. So meaning that on the first year I have to give depreciation, but when I'm disposing it, I don't have to basically calculate depreciation. So also this sentence is very important in the question. A. Prepare the following ledger accounts for the year end of 31st December 2014 and then balance the accounts where necessary and bring down the balance on 1st January 2015. Okay, so let's start. First of all, um, provision of depreciation account. Okay, so let's see what does the provision of depreciation account hold. Okay, and I believe this one should hold sorry, what does the provision of depreciation uh, so here you can see sorry, depreciation, what does the provision of depreciation account have? Okay, let's see it like that. And it says that any given time, the balance on the provision of depreciation account represents the total accumulated depreciation that has been provided against the particular asset. Okay, so for this, you can see it is 6,800. So the first thing I'm going to do is a balance brought down of 6,800. And remember, you always do it on the credit side when it's a balance brought down. I believe you always do it on the thing, but we'll see if that's wrong later on. But let me just make it neater so we know my values when I'm writing. It's 6,800. Okay, so pretty much that is it with the, for now, the balance BD. With the disposal account, he says that he bought a new motor vehicle for $17,000, and that's the one that's going to be depreciated. Okay, this one is Jan 1st. Okay, this one is Jan 1st. Okay, so this one is Jan 1st. Okay, and then we have to also record the depreciation on the motor vehicle account. So this one is April. Wow. Okay, I'm not gonna write the dates for now, but hopefully you understand. You just have to put the dates. You do get a mark for dates, so ensure you write that. So I'm just gonna do the full form. MV is equals to 17,000. Okay, and then after what you do is you say the disposal account. Okay, the disposal account, meaning from the disposal account. So the disposable account, I'm just gonna write DA 6,800 was the accumulated depreciation. Okay, and it says that we got 9,400. Okay, we got 9,400. So first of all, we will record the provision of depreciation right here for 6,800, and then we have the bank. Okay, we need to record because we got with the money, which is 9,400. And then finally we have the income statement, which I'm going to write IS as 800. Okay, so the income statement of 800. So the total right here would be 17,000. Now the income statement got the figure from balancing it, so done. This account is clear and done. With this account now, we have to calculate the income statement. Okay, and I need to first of all have the balance left. Now if I take my calculator and if I do 17,000 minus 6,800, I have 10,200, but I think this is not related. 40%. Okay, yeah, it's 40%. That's right. But if we do the depreciation, you will find a figure of 9,600 as your balance BD. Okay, so that's going to be recorded right here. So that's going to be, first of all, you can just write balance as BD 9,600. After you know that, you can just say the total. First of all, just do the total, and that you calculate the income statement and the balance CD. So the balance CD should be 9,600. We just recorded that, and also the income statement should be 9,600 to balance everything. And if we add both of the sides up, it should be balanced to 16,400 and 16,400, and we're done with this count. Okay, statement of financial position is quite simple. You just write motor vehicle, and then you write the cost. First of all, it should be 24,000, I believe. So 24,000. Accumulated depreciation, we have calculated that. which was 9,600. We calculated that, and that means the net book value is how much we after the depreciation is 14,400. Okay. See, calculate the depreciation which will be provided in the new vehicle. You just do 14,400 minus 14%, sorry, times 14%, and that should give you a figure of 5760. D, name the books General Cash Book. State the meaning of the revenue expenditure. Revenue expenditure is basically the money spent on the day-to-day running expenses, and that is it for number 4. So we're going to end the live stream a bit early, so hopefully you enjoyed this small type of live stream right here, explaining what straight line and diminishing and the purpose of depreciation and doing one depreciation question. So hopefully you enjoyed this video, and I'll see you in the next live stream or video. Goodbye.